Good afternoon, this is Jonathan Satovsky of Satovsky Asset Management, May 17th, 2017, providing a video blog update. And today I want to talk about two topics. One is risk tolerance, and the second is around value growth spreads. So today was the first material down day of 2017, and the political climate has been the culprit that you'll hear in the headlines. And that is going to call into question people's risk tolerance, because during periods when things are good, people are more tolerant, and when times are bad, they're less tolerant. And you can see this sort of behavior play out. And this goes beyond the debate about active or passive. I'm a believer in passive investing or long-term investing, and whether you're active or passive, it's my premise. Everyone is making active decisions whether they know it or not. They're making active decisions as to ascertain how much equity or fixed income they have, how much US exposure or foreign exposure they have, how much growth or value they have. But what you see materially happen, and my premise, more important than the cost of the investments, is the investor behavior, is investors perpetually sell after down periods and buy after periods are starting to rise. And that has happened most recently in 2015 and the first quarter of 2016. Everyone felt like, oh, prices are up, it's safe again to start investing. So, maybe after today, prices being down, people will start selling their investments once again. So time frame is very important. So if you're helping someone over a lifetime, you want to lean against the wind and lean against consensus and lean against someone's human nature, which is hard. So even though I'm a believer in exponential growth and technology and a lot of change that's happening, I still hold on to my roots of value investing mindset. And, evidence has pointed out that that has worked materially all around the world. This is just showing in the US, foreign markets and emerging markets, buying, again, equities cheap and profitable have worked. What you see by the red is it has not worked in the US in the last 10 years, which has a lot of people calling into question, why not just buy the markets? Why would I be a value investor? Why should I lean into smaller companies or cheap companies? That doesn't make any sense. Well, I'm here to show you a little bit of evidence to support the thesis. During the last 100 years, this most recent period was the third worst period in the last 100 years. And you can see this, the other two periods ending in 1939 and 1999. So why do I show you that? Well, if you're a believer in reversion of the mean and you understand the ideology of leaning against consensus, which is against someone's risk tolerance, someone's tolerant to buy something when it's rising and less tolerant to buy something when it's declining, when you're supposed to get excited when prices are declining, be greedy when others are fearful and fearful when others are greedy. If something isn't working is when you should get more excited and buy into it and buy into dislocation. But human nature isn't wired to do that. So I'm excited about value investing in the years ahead, even though people in the first quarter of the year have been piling into market cap weighted indexes. The question is, I have no problem with market cap weighted indexes. It's the question of whether or not someone's going to sit on that investment for the next 10 years, or the first sign of trouble, they're going to bail. So April showers bring May flowers. I wish everyone a wonderful spring and month ahead.